Well, welcome to another edition of FMD's Ask an Advisor. I'm joined again today by Michael Russell, Senior Advisor at FMD Financial. Michael, thanks for joining me.
Thank you for having me.
It's great to have you back. Today I want to ask you a question that we often get at FMD, and that's a question about the pros and cons of paying off your home loan versus putting further money into superannuation. And this particularly comes into play, we find, the questions come from clients who are perhaps at a point in their lives where school fees are now over, cash flow starting to increase, some of that really intense spending period is done, and retirement's becoming closer on the horizon. What do you typically talk about when clients ask you about that?
Yeah, look, it's a really good question, Lee, and I think in that period that you're talking about, I'm going to say sort of 50s, but I mean, leading up to retirement and you've got the kids' fees perhaps sort of winding down or finishing, a lot of clients do find themselves with that surplus cash flow each month.
Yeah.
And assuming there's still a bit of a mortgage outstanding on the family home, non-deductible debt, and we've got, on the other side, we've got super balances that we're trying to build, and we've got this disposable income. Where do we put it?
Mm-hmm.
I think, as a general rule of thumb, if we're looking purely financial, superannuation makes a lot of sense. But when we're younger, I think that the distance to retirement, the fact that it's locked away until your preservation age, becomes a bit of a disincentive, even if the financials stack up.
Yep.
As we sort of get into that pre-retirement phase, then people have a bit better look at super versus reducing non-deductible debt. The advantage of putting into super is if we're earning $1 gross, we're going to pay contribution tax going into super, which is going to range sort of between 15 and 30%, where if we take that money in our hand or into our bank account
As salary,
yep, it's going to hit that account, and we're going to have our marginal tax rate plus Medicare taken off. So the dollar that we've earned gross ends up being perhaps somewhere between 34 and 47% less when it hits the account.
Yeah.
Then I guess if we want to see which way is better, because our window to retirement is becoming much shorter, it really comes down to taking into account that tax saving on the way in versus the return we can get in super versus the saving, I guess, of reducing our debt.
Yeah. Because if we're putting money in super instead of paying off the home loan, we've still got interest to pay, and that's not deductible, and we've got capital repayments to make as well, yeah?
That's right.
So how do you weigh up the two?
Well, I guess when we weigh up the two, we're going to have to use some assumptions, because we're looking at future interest rates of the loan, and we're looking at future returns of the super fund that we're invested in.
Yep.
But we can model this, and we can use assumptions and get a pretty accurate forecast of where it all sits. Yep. One of the ways that I like to do it with my clients is using the FMD Super Modeler, which gives us a really good, easy inputs, I guess. We put in earnings rate, how much our super balance is, how much we've got in our super accounts, and we use that and we can forecast where our super will be, and gives us a pretty accurate sort of indication of where we'll be at. And
so then you can put the extra super contributions into that model and see what the difference is. Super versus...
so we put the extra contributions in, model that, and then if we want to, we can also we can model paying down the loan as well. Not with the super modeler, but we've got a separate way of doing that.
Yeah, right. And so ultimately, for the strategy to work, you need to believe that the additional contributions into super, which go in lower taxed, will grow faster than the perhaps slightly slower repayment of interest on the home loan.
And I guess the paying down the home loan, it's a known to some extent. We've got a saving, I guess, instead of a return by paying down that loan. And if you've got a mortgage of 6%, we know that we're going to saving 6% or earning 6%. It's virtually the same, minus the difference in tax payable. Where on the other side with super, we've got a little bit of unknown in terms of our return.
Yeah.
So it feels like paying down the mortgage is a safer option, but if we look at the longer term returns of super funds, and I'm just using a balance fund as an example, that's going to be a better return plus the tax incentive than the paying down the mortgage. Saying that, I do acknowledge that mortgage rates are higher now than they have been the last sort of couple of years.
Yeah, so it's not a black and white decision, but it's one that's certainly worth asking if you've got some spare capacity at this point in your career.
Definitely, I guess you need to consider it, Lee. That's the short answer. You need to be looking at that and making sure that's part of your end goal and your retirement planning, that you take that into consideration and at least see where you could end up by making those changes.
Yeah. All right, so I think the message out of this one, as always, really is if you've got a question about that decision, whether you should contribute more to superannuation or pay off your home loan, you should talk to your advisor. So, Michael, thanks very much for joining us today.
You're welcome, Lee.
And look forward to having you back as a guest soon.
Thank you.
Thanks.